Hello everyone, welcome back to the channel. So in today's episode, I'll be covering why Visa as well as MasterCard are decent buys in today's market and why I recently added to my Visa position in this 10% or so sell-off. So this is a newsletter that we'll release. It is a Substack that is related to Visa as well as MasterCard as well as the current credit cap that Trump is imposing on the entire US economy. So it says over here, market swings are normal, and in the case of Visa as well as MasterCard, they are our victims in today's market. So Trump recently just introduced a new policy. He said that he wants to curb all the credit interest rates at 10%. He wants to put a ceiling in terms of your credit interest rates. And this is, in my view, a move that could hurt the US economy because the US economy is entirely reliant on credit. So your US consumer, for example, has around $1.23 trillion of credit loans. And a credit loan could lead to your banks pushing for credit limits, which could lead to a liquidity shock, which could eventually spiral into a weaker consumer and so on. So your current credit interest rate is on average around 19%, and the limit now is to put it at 10%. So it's half of what the average is today. And besides that, this is another point that's overlapping with the first point, which is that your credit companies, they lend on a risk-adjusted basis. So while 10% seems fair to all, it fails to account for the risk that they are taking on. And when your banks can't lend the money at a profit, no bank will rationally do that. So the argument today in terms of Visa as well as MasterCard is as follows. When you have an interest rate ceiling, what happens as a result of that is that your credit loans, your credit card usages will start to fall because of the limits itself. And then what happens after that is your transaction on Visa as well as MasterCard railways will start to decline. So that is the main concern that the market is seeing today, and we'll be addressing the main bear theses in this entire newsletter here. So in the case of Visa as well as MasterCard, we'll try and assess the different bear theses case by case, and I would like to also acknowledge the fact that credit card volumes could be lowered. This will in turn hurt Visa as well as MasterCard's transaction volume. But before we go into that, let's try and draw the line on what Visa and MasterCard are actually reliant on. So Visa and MasterCard are payment rails, and they do not directly benefit from an increase in terms of your credit loans. What they benefit from is increased transaction volumes. So there's a key difference between the two. Credit card loan refers to how much money is left that is unpaid by the consumer that your banks earn interest on. Transaction volumes, on the other hand, is what is transmitting through the payment rails. So it is done using a debit card or credit card. While there is some relationship between the two, it is not directly proportional. So a narrative online right now is that Visa and MasterCard will be affected by this because when your interest rates are capped, what happens is it will lower credit card volumes, which will hurt Visa as well as MasterCard. But the key to this is to assess the extent and how the market has reacted. So Visa and MasterCard are down around 10% over the past few days. So this implies that the markets are either pricing in a 10% decrease in terms of earnings next year, or 10% decrease in terms of the predictability of the firm, or a mixture between the two. So recent reports have suggested that when this credit cap is put into place, only those with FICO scores above 740 points, which is your super prime, will be able to use their credit card and will not face any form of credit limit. So this would affect around 80% of Americans that use their credit cards. And this also means that if the 10% cap comes into place, there will be credit limits to all those 80% of US consumers, thereby affecting credit card volumes, hence affecting Visa as well as MasterCard, the payment rails. However, there's a stronger argument to this. Your super prime consumers are the ones that make up the majority of the volumes on your credit cards. So for example, over here, this is from Philadelphia Fed. So it says consumers that are in this super prime group, they make up around 2/3 of total accounts and around 80% of credit card volumes. So a similar trend can be extrapolated throughout the entire US. And based on the numbers, if you were to account for the total transaction volumes for Visa as well as MasterCard, in the case of Visa, it has around 48% of total global transaction volume in the US. And credit cards make up around 48% of that total transaction volume. So what that would mean is that 5% of the total transaction volume is actually hurt as a result of this 10% cap. This is the direct effect of this 10% cap. And so a 10% drop actually seems a bit exaggerated. Adding on to that, there's a further argument to this as well. So of course, all these assumptions are on the basis that your consumer remains strong. So first of all is that those that are currently using credit cards, it can simply swap over to debit cards. So your transaction volume on Visa, it is not actually lost, although your debit cards are lower margin as compared to your credit cards. Second portion is that you have this buy now pay later option in the US especially. So BNPL is also an option for your US consumers. And based on the data over here, majority of BNPL users are actually your super prime consumers, which is the one that is most likely to be hurt. So a credit limit leads to a natural switch from credit cards to BNPL. And BNPL cards are actually also on Visa as well as MasterCard rails. So this will directly drive volumes to Visa and MasterCard. So the banks will also see a massive hit in terms of their interest income, and what they will do is they will likely increase their different fees and try and make up for the difference in that, all of which will still have to flow through Visa as well as MasterCard. The last concern is that there could be pressures from the different banks to try and lower Visa as well as MasterCard's interchange fees. This is unlikely. And second option for the bank is that they could create some form of a closed loop system, something similar to what American Express has. But this is high capex and it requires a lot of trust, it requires a lot of time, and this is an unlikely option for all the traditional banks in the US. An alternative is also stable coins, and stable coins are currently not really supported in the US as well. So over here it says US credit unions, they join banks in rejecting reward payments for holding stable coins, while crypto traders await US inflation data that could boost Bitcoin buying. So your stable coins are currently not really supported. So that's an alternative that is weak right now. As for consumer weakness, the only way for us to assess this is through extrapolation from the past. And in 2020, if you were to look at the revenue for Visa, revenues only fell by around 6%. So revenues falling 6%, the current multiple is at around 28 times. The lowest multiple in the past 10 years is around 25 times. So what that means is that the downside protection is around 16% from today's price. The upside is limitless in terms of Visa. It has a long runway of growth ahead. The TGR is probably a lot higher than the general markets. So I think in the case of Visa as well as MasterCard, the sell-off is exaggerated, and that's why I recently added to my Visa position. A further thing to add on, so besides the economics for Visa and MasterCard, there's another element to it as well, which is that the law, the rule, is unlikely to pass through. So the markets are already pricing it in as though it is going to happen, but this is unlikely. So over here it says on Friday, the president called for a 1-year 10% cap on credit cards. This is seen as some sort of a populist idea. So over here it says, I wouldn't get too spun up about ideas that are out of the box that are proposed or suggested. So moving on, they said that it would be legally risky because it would likely involve the Consumer Financial Protection Bureau, an agency the Trump administration is trying to dismantle. So the result is that Trump's push will face steep obstacles to enactment. It is very challenging, and the CCCA looks a little more realistic than the 10% credit card cap, which is already having cold water poured all over it by Johnson and others, but both are difficult. So some of his Republican Party members are speaking openly in the case of Trump's proposal. They're saying it's horrible policy, it is populist, and so it's unlikely to pass through. The last cause of concern is this thing here, which is your Credit Card Competition Act. This is your CCCA. So Trump, he endorses it. He endorsed it a few days ago. That was what led to the drop. So if you were to look into this act, it is an act to try and curb the increase in terms of your swipe fees. So over here it says credit and debit card swipe fees have risen by 70% since the pandemic and have reached a record high of 187 billion. And it is most merchants' highest operating costs after labor, so the fees are too high. And then adding on to these concerns over here, it also says that Visa and MasterCard, which control 80% of the market, each centrally set the swipe fees charged by banks that issue cards under their brands and also block transactions from being processed over other networks that could do a job at a lower fee and with better security. So the legislation will require banks with at least $100 billion in assets to enable cards they issue to be processed over at least 2 unaffiliated networks, Visa or MasterCard, plus a competitor, which is your NYCE, Star or Shazam. So I think this is another concern that the market is pricing in today. So there's a few possible counter arguments to this. First of all is that Visa and MasterCard, they provide the rewards for the consumers. So if you introduce an alternative payment network, you introduce another one that the bank is going to use, what you're basically telling the consumer is that you will lose your rewards. Second of all, Visa and MasterCard's US transaction volume is a minority in terms of their total transaction volume. This was covered earlier as well. Third of all is that your value-added services will still have to come into play, meaning that companies still probably has to get some form of consulting, cybersecurity from Visa as well as MasterCard. So either ways, I think the most important thing for Visa as well as MasterCard, the biggest moat besides the network effects, besides the infrastructure, is the brand for the firm. There's the trust that it has built with consumers all these years. And if a consumer had to pick between using a Visa affiliated card and another card, I think the consumer will prefer the former. Anyways, I hope you guys have found this video useful, and I'll see you guys soon.